inflation rate for the month of January dipped slightly by 0.3% to 15.6% from the 15.63% recorded in December 2021. According to the figures released by the National Bureau of Statistics, inflation figures is 0.87% lower than the rate recorded in January 2021 at 16.47%. This shows that headline inflation rate slowed down in January when compared to the same month in the previous year. Food sub-index also dipped to 17.13% in January this year from 17.37% recorded in December 2021. Core inflation was steady at 13.87%, indicating a 1.25% increase on a month-on-month basis. Urban inflation was also steady at 16.17%, while rural inflation dipped to 15.06%. Let's discuss this indices forming the drop in inflation figures and the impact on consumers. Joining me via Zoom is an investment research analyst, United Capital PLC, Mr. Ayorinde Akinloye. Ayo, it's good to see you. How are you today?
Very good, Tolu. Good afternoon. Thank you for having me on this show.
Yes, we saw that a little bit of uptick in December, and people said it was because of the festivities, the buyings, and all of that. And we now saw a dip in January. I didn't know it was going to be so quick. What were you expecting, and what do you think is responsible for this slight decline?
Okay, yeah. So, like you rightly said, in December we saw that on sudden reversal in inflation numbers, and inflation ticked higher in December. And but we note that prior to that, inflation has actually been on a downtrend for about 8 consecutive months, and has been driven by the fact that 2020 was a very high base when calculating inflation numbers for 2021. And but in January, what we saw was a decline, and clearly what we were expecting was actually a decline in inflation, because December was more of an outlier month when you look at the factors that drove the increase we saw in December. So, like you mentioned rightly, the festive demand was the big factor here, particularly strong demand for food items in December. Demand for food items was quite high relative to limited supply due to the supply side constraints that we've seen over the past roughly over the past 1 year now since the COVID outbreak. So that puts upward pressure on food prices in December. But heading into 2022 in January, we expected that momentum to decline, because the idea was food demand would steady, and then we would see that that slower increase in food prices, which was why we saw food inflation actually decline. But when you look at most of the other key items in the inflation basket, they actually recorded an uptick on a year-on-year basis and on a month-on-month basis. So when you see food inflation declining by roughly about 24 basis points, but the headline inflation itself declined by about 3 basis points, then you clearly can see the fact that the driver of the decline in inflation was mainly from slower increase in food prices, and that was largely in line with what we expected. And even when you look at it from our in-house forecast and then consensus forecast, when you look at across the industry, the decline in inflation that was expected was actually more than the 3 basis points that we saw. We expected to see at least some 10-15 basis points decline in inflation. So the decline was actually slower than we expected, which was some sort of negative surprise for us. But the large driver of the decline in inflation was mainly food prices, and the decline in food prices was offset by some other key items. For example, you look at utilities. Utilities, that's talking about rents, talking about price of other petroleum products like diesel, which increased significantly because of the increase in oil prices, and we know that the price of diesel is not deregulated. Also key items like electricity bill, water bills, and things like that. Also imported inflation was also another critical thing that sort of offsets the decline in food prices too. So imported inflation, particularly when you look at imported food items and imported commodities like maybe clothing items, footwears, maintenance equipment in the vehicle or in the transportation industry also. So when you combine all these little forces together, it was enough to sort of dent the decline we saw in food prices, the decline in food inflation. So we saw that muted 3 basis points decline, and basically culminated in being a negative surprise really in inflation numbers.
I would like to play the devil's advocate here because many talk about that we see these figures, but the reality is that the price of food stuff at the market at the moment, there's been no reduction in the money is being paid or maybe to buy food stuff and all of that. So the impact on the pockets is what I want you to really talk on at the moment. Now, what do you think? What does this mean for an average Nigerian? Inflation at 15.6%. How does it affect the Naira and Kobo?
Okay, yes. So when we break it down to layman terms to try to understand really what does this mean for Nigerian consumers, right? You look at, we say food inflation declined month on month. So, but that does not indicate that food prices declined in January. It actually indicates that food prices increased, but it increased at a decreasing pace. So the rate of increase in food prices, was slower in January compared to December, which is quite intuitive considering the fact that there was strong demand, due to festivities in December. So when you look at the fact that inflation declined marginally, or when you take out the December outlier, inflation has been declining for about 8 months now, but consumers are saying they are not feeling the impact on their pockets. Prices are still increasing. So inflation basically measures that rate of change, right? Is the rate of change in commodity prices, basically, grouped together as a basket. And the entire idea is, if inflation is declining, it doesn't mean that prices are declining. It only means that prices are increasing at a slower pace, right? So for consumers, what they need to know is the inflation environment still remains very high. So even if prices are increasing, but we say the rate of increase in price is slowing, that does not really paint any picture of respite for the consumers, because if on a year-on-year basis, inflation is increasing by 15%, which, just taking where we are, for example, 15.6% is where we closed January at. If prices are increasing 15.6% every year, every year for consumers, are they getting that commensurate increase in their income? Those are factors that you also consider, you look into. So for consumers, this does not mean any significant positive, really, because inflation is still very much elevated and very high. Yes, the rate of increase in prices, we are seeing it, simmer a bit, but that does not provide any respite to consumers, because it's like inflation was at maybe 16% before, and then it has been steadily declining to 15% levels. 15% and 18% for consumers, it still makes no difference. Why? Because prices are still increasing and it's hurting their pockets. Why? Because income is not, the increase in income is not catching up with the increase in prices, and that is where Nigerians, have significant concerns that they are not earning enough to catch up with the increase that we are seeing in prices of food items, in paying of rent, in buying alternative fuels, paying your electricity bills. Your income is not growing fast enough to catch up with the increases in prices like this. So that is the main concern for Nigerian consumers. And the fact that inflation declined marginally in January does not change that picture. It does not change that scenario at all.
Now, let's also talk, before we look at the effects on the monetary side, because we expect that this will also always have an impact on monetary issues and all of that. Would you say that the policy direction of government focused on economic recovery is playing out well? Are we doing well? Are we getting back to full-time business? A little bit of issues around COVID, but I think it's getting better when you want to look at Nigeria. Are we picking up, if you look at the fundamentals surrounding all of these figures?
Okay, thank you. So that's a very, very interesting question, actually, to break down, particularly when you look at it from perspective of comparing it to other countries that are also experiencing significant surge in inflation, right? So let's bring it home. First, clearly from directly answering your question is, we can't clearly say that we are back to where we need to be as an economy in terms of economic growth. And again, that could be relative. So if we're talking about where we were before the COVID outbreak, we can say yes, at least we are back to where we were before the COVID outbreak. But even before the COVID outbreak, economic growth was broadly uninspiring. We've been doing roughly between 2 to 2.5% growth for most of the past roughly 10, for most of the past roughly say 5-6 years now. And even in most quarters, GDP growth continues to track below our population growth, which implies that GDP per capita continues to decline. So when you look at it from the aspect of where the Nigerian economy should be in terms of growth and in terms of GDP per capita, we are far from where we need to be. Now, when you introduce the fact that inflation is at multi-year highs, but at the same time, growth is not tracking, the growth in the economy is not tracking the increase you are seeing in inflation, then you can clearly see a scenario where the Nigerian economy is really performing below par. Now, creating a comparison with peers, in the US, inflation is at 40-year highs since 1982. For January, inflation in the US printed at 7.5%, and that is that's significantly high for the US economy, considering it's a more advanced economy. But the reason why we are seeing inflation at that level is because the economy has basically, the economy is overeating from the strong rebound in economic activities, with GDP growth at multi-year highs, and you can clearly see the correlation between the significant increase in economic activities, which is leading to increase in prices, and as a result leading to inflation, because consumers are now demanding, consumer demand is now stronger, corporate demand is stronger, and so demand for goods and services generally in the economy is much stronger. You can speak of the same thing in countries like England, for example, or even taking the Eurozone as another example. When you look at the Eurozone, inflation is at record highs, but economic growth too is at record highs. So what they need to do is clear for them from a policy point of view. From a policy point of view, they know they need to tackle inflation. But for us in Nigeria, inflation is significantly high, but growth is still uninspiring, which basically puts us in more or less like a situation where we are facing a stagflation, really, where inflation is, jumping significantly, where inflation is extremely high, but economic growth is not tracking up with that. So that puts us in a very concerning situation and makes it difficult for policymakers to know which to attack. Do we attack uninspiring economic growth, or do we attack the persistently high inflation? Because both of them require contrasting policies to achieve desired results. Now, when you look at the scenario we find ourselves, it basically speaks to the fact that there are structural issues prevailing in the economy. So if you have an economy that is not growing at a very, for example, for the Nigerian economy, you'd imagine that considering the level of inflation we have, as well as considering the fact that we are still a frontier economy, or in some cases an emerging economy, our GDP growth or economic growth should be comfortably above 3, 4, 5% levels, which was what we were doing before 2015. So if we are going to get ourselves back to that level of growth, we need to deal with the structural issues that we have within the economy. But again, those are issues that will still take a long time to resolve, and continues to put policymakers basically in a conundrum on what to do, either to focus on inflation or to focus on the uninspiring growth that we are facing. But overall, yes, the policies that have been put in place from the CBN, fiscal authorities, has managed to drag us out of recession. But again, you can argue that even without some of these intervention policies, there is a very strong chance that Nigeria would have still exited recession based on just seasonal factors and the fact that we had a low base for economic activities in 2020. So clearly more needs to be done to actually restore GDP growth back to where we were before the pandemic.
Brilliant submission there from you, Ayo, as usual. Before I let you go, Ayo, what are the possible impacts, particularly on monetary policy, looking on, and of course investors, investment returns for investors?
Okay, yes, clearly. So first, from an investment returns perspective, quickly, and then I'll take the monetary policy part last, because that's pretty much very interesting also to elucidate on and watch out for. For investment returns, clearly, just about, if you look at the entire yield curve, so when I'm saying the yield curve, that's interest rates on different debt instruments. So talking about the bonds, treasury bills, and all. When you chart the entire sovereign yield curve, from the 3 month instrument down to the 30-year, which is the longest tenor on the yield curve, the entire yield curve is below inflation rates, which means that no matter the instrument you invest in as an investor across that yield curve, you're going to be getting negative real return, which is one of the problems foreign investors have with the Nigerian economy at this point in time. Yes, there are so many issues that they have, but the fact that, the return on their investments will basically be negative from a real perspective, because when you take out, I think the highest, the 30-year bond is returning roughly about 13%, and inflation rate closed January at 15.6%. So if you are going to invest on the longest tenor instruments, you are going to be earning a negative 2.6% real return on your investment. Not to talk on investing on 1-year T-bills that is doing roughly 5.2% and other instruments like that. So it's definitely has a negative implication for investments. And when you also look at the prognosis for inflation rates, we expect that the decline we saw a decline in January. We expect to see further declines in February and then also in March. But we look at April as a critical turning point, as a critical inflection point for inflation, where we expect inflation to begin to actually trend higher. So we begin to see another case of inflation of reinflation in April, and it means inflation will basically be higher from April down into the rest of the year. So it's a situation whereby we are expecting to see a much higher inflationary environment later in the year. So for investors, it becomes a big problem when expected inflation is even higher, that is likely going to be higher than where we are now, and the entire yield curve is already below that. So as an investor, it's discouraging for you to invest in the Nigerian economy, of the Nigerian capital market as it is now, considering your negative real return. So it's critical to try and find ways to ensure that investors are incentivized to still be willing. Yes, there are a couple of investors that they have no choice. They have to invest in all these instruments and continue to deal with the negative real return. But in the long run, it basically means that the value of your investments, the value of savings is actually declining, and the value of the naira continues to decline. So purchasing power would also be affected really in the long run. So clearly, a lot needs to be done to improve what investors earn on their investments. Now, clearly moving to monetary policy, clearly for the CBN, it's a bit of a dilemma. Like I mentioned, the CBN the policymakers are in a serious conundrum right now because growth is uninspiring and inflation is persistently high. So the concern for them is, which do we tackle? If we are going to tackle uninspiring growth, we have to be accommodative in terms of monetary policy. It means we have to allow interest rates, fall in order to allow there to be creation of liquidity to support business ventures and basically drive economic activities. But on the other hand, when you release significant liquidity into the economy, particularly into an economy that has significant structural problems in terms of, the infrastructure layouts, institutions around business environment. I mean, we've discussed these issues so many times. When you release so much more liquidity into such economy, that liquidity may not end up finding its way into productive activities that will increase economic growth. So that is the problem for the CBN. They can't just afford to go dovish on monetary policy, that is, reduce interest rates, try to pump in more money into the financial system to drive economic activities. They can't do that because the economy has significant challenges that needs to be resolved to support that. And that pumping so much liquidity could actually lead to increasing inflation. To tackle inflation, they need to increase interest rates. They need to, go hawkish on monetary policy, similar to what we are seeing in developed economies right now. But the problem with that is, if they go further to tighten monetary policy, that will lead to increase in interest rates. Yes, it would help solve the problem of negative return on investments for investors, but on the other hand, it would discourage business owners and other business owners basically in the economy from borrowing funds in order for them to engage in productive economic activities. So you are going to halt economic growth, right? So the CBN is basically in a conundrum, but in the long run, we feel that they will try as much as possible to resist that hawkish monetary policy approach until later in the year. But we think that in 2022, the CBN would have no choice than to hike monetary policy rates later in 2022, which means the landscape for monetary policy is biased towards the hawkish side of things much later in the year. We totally rule out a decline in MPR or a dovish approach from the CBN because that will significantly halt inflation. We think a hawkish approach would be the most likely outcome, particularly from the second half of the year. So when the MPC meets probably in its July meeting or its September meeting later in the year, we likely would see the MPC actually increase the MPR to stem the increase in inflation. Mind you, we have our expectation that inflation will still continue to increase, particularly from April. Inflation will continue to increase, and that will be a main concern for them. Also, exchange rate is also a key concern because foreign portfolio inflows are not coming in significantly as they want, right? And there is that need to also try to attract foreign portfolio inflows. Yes, the CBN is trying other policies like the RT 200 FX program that the CBN came up with to attract long-term non-oil exports revenue in terms of FX, but that is more of a long-term policy over the next 3 to 5 years. What will the CBN do over the next 6 to 12 months? External reserves are declining, so there needs to be a short-term fix, and that short-term fix would be trying to attract FPI flows, which will require you to increase interest rates in order to ensure that real return becomes positive. And then at least you can begin to attract some FPI flows, which would now support external reserves and strengthen and give the CBN more room to defend the currency. So when you put all this together, it's basically a case where the CBN has no option than to consider increasing interest rates later in the year.
Brilliant there. Mr. Yorinde Akinloye, I must thank you so much for your time, making us understand this topic of discourse. Investment research analyst at United Capital PLC. Do enjoy the rest of your day.
Thank you very much, Toyo.